In Chapter 1 of A Random Walk Down Wall Street, titled Firm Foundations and Castles in the Air, Burton G. Malkiel begins by explaining the essential theories and philosophies that form the basis of investment strategies, and how these interact with the idea of a random walk in the stock market. This chapter sets the foundation for the book, outlining two key approaches to valuing assets: the firm foundation theory and the castle in the air theory. Malkiel also explains how investing has become a widespread activity and introduces us to what he refers to as a random walk in stock prices, which plays a central role throughout the book. What is a random walk? The title of the book refers to a random walk, a concept central to understanding Malkiel's views on stock prices and market efficiency. Simply put, a random walk refers to a sequence of random steps in which each step's direction is independent of previous steps. In the context of stock markets, Malkiel uses the term to describe stock prices. He asserts that stock prices move in a manner that cannot be predicted based on past movements. In other words, tomorrow's price changes cannot be forecasted based on today's or yesterday's movements, as new information becomes available randomly, impacting the market unpredictably. Malkiel introduces this notion early to highlight the unpredictability of financial markets. Stock prices are driven by a combination of factors, and these forces are often beyond the comprehension of even the most seasoned market analysts. Therefore, trying to forecast future price movements based on past data is, in his view, like trying to predict the path of a random walk, essentially a futile exercise. The idea of the random walk serves as a critique of various investment strategies that claim to predict market behavior. Malkiel argues that because stock prices reflect all known information, there is no consistent way to beat the market through prediction. This leads him to champion passive investing, an approach that seeks to mirror the market rather than try to outperform it. Investing as a way of life today. Malkiel opens the chapter by addressing the fact that investing has become a way of life for many. The stock market is no longer an arena for just the financial elite. Instead, it has democratized over time. More people are participating in the stock market than ever before. This trend toward mass participation has been fueled by factors such as the rise of mutual funds, easier access to financial markets, and more recently, the rise of financial apps. He notes how the average investor now has access to the same types of financial vehicles that were once reserved for institutional investors or the wealthy. With the advent of online trading platforms, robo-advisors, and index funds, the barrier to entry in the stock market has lowered considerably, making it possible for almost anyone with modest savings to become an investor. The democratization of investing, however, also comes with its own risks. Malkiel cautions that many new investors enter the market with the mistaken belief that they can outsmart it. He emphasizes that without proper financial literacy and an understanding of market theory, these investors can easily fall prey to emotional decision-making or follow investment fads that can lead to substantial losses. Investing in theory. To explain how different schools of thought approach investing, Malkiel introduces the notion of investing in theory. There are various philosophies about how to achieve success in the stock market, and two of the most prominent theories are the firm foundation theory and the castle in the air theory. Malkiel sets the stage by explaining that much of investing is underpinned by theories about how to value a stock. He describes these theories not just as academic constructs, but as frameworks that investors rely on, often implicitly, when making decisions about buying or selling stocks. In general, Malkiel explains that the goal of investing is to achieve the highest return possible while managing risk. However, the methods investors use to value stocks and forecast future performance can differ greatly, and that's where the two contrasting theories come into play. The firm foundation theory of investing, according to Malkiel, posits that every stock has a true or intrinsic value that can be calculated based on the firm's financials. This value is determined by analyzing factors such as earnings, dividends, cash flow, and the overall financial health of the company. Once this intrinsic value is determined, the investor can then decide whether the stock is undervalued and therefore worth buying, or overvalued and worth selling or avoiding. In the context of this theory, investors view stock prices as reflective of real-world economic fundamentals. For example, a company's profits and growth potential are seen as the driving force behind its stock price. By analyzing balance sheets, income statements, and financial ratios, investors aim to determine whether the stock price accurately reflects the company's financial standing. Proponents of the firm foundation theory, such as legendary investor Benjamin Graham, author of The Intelligent Investor, believe that a methodical, analytical approach to stock valuation is the key to success. Graham famously referred to the stock market as a voting machine in the short term where emotions and speculation drive price movements, but as a weighing machine in the long term, where true value eventually prevails. Malkiel points out that many investors believe in the firm foundation theory and use it to guide their stock-picking strategies. However, he also cautions that even the most diligent analysis of financial data cannot fully account for the randomness and unpredictability of stock market movements. The castle in the air theory, on the other hand, takes a more speculative approach to investing. According to this theory, the value of a stock is not derived from its underlying financials, but from the collective psychology of the market. Essentially, stock prices are driven by what investors believe the stock will be worth in the future rather than what the company is actually worth today. In this theory, prices are not grounded in the firm's financial reality, but in the perceptions and expectations of investors. Malkiel uses the example of John Maynard Keynes, who famously described stock market investing as a beauty contest where the goal is not to pick the most beautiful contestant, but to pick the contestant that other people believe is the most beautiful. In other words, stock prices reflect market sentiment, not intrinsic value. This theory is the basis for speculative bubbles, where stock prices rise far beyond the value suggested by a company's earnings or financial position, only to come crashing down when reality sets in. Malkiel points to various historical examples of such bubbles, including the Dutch tulip mania of the 17th century, the dot-com bubble of the late 1990s, and more recent events like the housing bubble leading up to the 2008 financial crisis. The castle in the air theory argues that investors can make money by predicting how other investors will behave. It is less concerned with whether the stock is intrinsically undervalued or overvalued and more focused on market psychology and trends. At this point in the chapter, Malkiel introduces how the random walk will play a role in the rest of the book. He suggests that since stock prices are unpredictable and follow a random walk, it is incredibly difficult, if not impossible, to consistently outperform the market through stock picking or market timing strategies. Malkiel argues that investors would do better by adopting a passive strategy, such as investing in low-cost, diversified index funds. Rather than attempting to predict price movements, a random walk approach embraces the uncertainty of the market and focuses on long-term investing. The idea is that while individual stock prices may be volatile and subject to random changes, the overall market tends to trend upward over the long term. 1. The concept of a random walk. Stock prices are influenced by new information and unpredictable factors, making it difficult to predict future movements based on past data. 2. Investing as a way of life. Investing has become a widespread activity, accessible to more people than ever before. However, it requires financial literacy and a well-informed approach to avoid common pitfalls. 3. Investing in theory. Investors rely on different theories to value stocks, and two of the most prominent are the firm foundation theory and the castle in the air theory. 4. Firm foundation theory. This theory posits that stocks have an intrinsic value based on financial analysis, and investors can achieve success by identifying undervalued stocks. 5. Castle in the air theory. This theory suggests that stock prices are driven by market sentiment and collective psychology rather than intrinsic value. 6. The random walk. Given the unpredictability of stock prices, Malkiel advocates for a passive investing strategy, such as investing in index funds, rather than trying to beat the market through active stock picking or market timing. This chapter lays the groundwork for understanding Malkiel's advocacy for passive investing strategies over active management. It introduces readers to the notion that trying to predict stock prices is a largely futile exercise due to the random nature of the market.
Thank you for watching. Share this with friends and family, and please subscribe.